looking for strategic investors is a really important one. And I know that for a lot of founders that we work with, especially when they're thinking about looking for angel money, something that they might not necessarily be focused on is looking for angel money from individuals who have some sort of like expertise or knowledge base in the particular market that you're working in. And I know that AngelList kind of now provides all of that background. So maybe Kevin, you can talk a little bit more just about the type of information that's available through the platform on the investors that you can access.
Yeah, well, I mean, I'd say the most relevant stuff to look at when you're reaching out to investors or considering an offer is what other companies they've invested in, and then whatever sort of research you can do on people who have worked with them is like going to be the biggest indicator. So I mean, there's people leave reviews on sites. You can read those, and you can see what exits they've had in the past. But yeah, I think it really is. I mean, it really does just matter like if someone's a match for you. It's not, you're not just looking for capital, full stop. You're looking for capital like and someone to keep on board for a long time who's going to continue growing the business with you. I mean, maybe these things are obvious, but the best way to figure out whether that's going to happen is like do sort of the networking research. That I think, I mean, I assume on the venture side, you guys do plenty of that with founders as well, and it's just as relevant from the entrepreneur side, who they've worked with and what those people's opinions of them are.
Yeah, I think definitely that's been true for us. I mean, what we did when we started out was to just make a list of 20 people. Angels that had exits in our space that were very relevant to us in our business in the future. And we just started talking to them, and we never at any point, like, our ultimate goal was to raise a round and to have some of these people on board, but we never asked them for money. So we only asked for advice. And I think that's where that's not sort of what you do on AngelList. That's sort of all about money. But eventually we found that by asking these people for advice and having them engage in our company and in our growth over even a very short amount of time, these people started wanting to invest themselves, and that was a very good route to have. To just make a list of people that you want to get advice from, that you ultimately would like to even give equity as advisors, maybe, and then have them invest. So yeah, again, very obvious, but that's worked very well for us. And that was something that our lead investors in the seed round really liked as well. And they even brought on more angels that they knew and liked from Facebook and Google, and people that could really help us along. And that's been really helpful.
Also, I'd say Angel is a good place to reach out to advisors too.
If
you want.
Not all of them.
Yeah.
And then Chris, from the investor side, what's the type of, and you can speak to your own personal experience too with companies that you've worked with, but what's the type of resources that you guys provide that kind of go beyond just capital, or when you're looking for in founders that you really want to dig in and work with?
Yeah, so a few things. I think we try to think of ourselves as value-add investors. We like to roll up our sleeves, and at the end of the day, really be an extension of the entrepreneurs network. So we have a number of formal things that we do and a number of informal. On the formal side, we have a CIO and CMO council. So these are Fortune 500 CIOs and CMOs, two separate groups that we put our portfolio companies in front of to help jumpstart the sales cycle, to get product feedback, customer development, possible advisors. They also help us vet companies before they're in our portfolio. So a number of interactions we have with these high-level folks. So that's kind of on the formal side. We also do a number of recruiting events, whether it's at Stanford GSB or engineering school. So really anything in and around building a company, we try to put effort and really provide services around that. And I'd say the number one thing is really just on the business development side. So we have a BD call on Mondays with a handful of portfolio companies each Monday and say, what are the top 5 things you need and then we go have somebody who just hunts after those 5 things, whether they're customer intros or someone you want to hire on the engineering side, whatever it may be. So that's really how we institutionalize it. And there's obviously the one-offs. And so I think as an entrepreneur, you're really looking for the firm that can provide you the most value. At the end of the day, you're exchanging value for capital. So to everyone's point, find folks that are in your space, that are passionate about it, diligence them, and find a firm that you ultimately can see a kind of a long-term relationship with, because it's difficult when things aren't going well and you have someone on the board that you don't like. Those things get ugly, and we've seen them happen many times before.
And Ant, can you maybe speak to, it's just popped in my head, like the transition between, because you guys, when you raised your seed round, you had a bunch of different investors coming in for that, and then the majority of your Series A came from one firm. So does that change the dynamics of the relationships with everyone, or how does that work?
Yeah, that's it. We're 3 weeks in, we're still discovering this. We used our investors, and just like Bloomberg Capital, a good investor provides you with that support. Even if they're seed stage, they help you hire, they help you market to your hires, they help you do press. And so we remain aggressively expecting of our seed stage investors of Andreessen and of Greylock, who didn't come into our A round because we failed it. We have a fantastic relationship with them. I update them once a month on very transparent growth numbers, and in return they continue to help us recruit, they continue to help us do PR when we have big product announcements. But it does raise they are competitive. They're as much as we found venture capital funds would pretend that they're not competitive with each other. Of course they are. There's for hot deals there is competition, and we found that it's a wonderful problem to have, that we've decided to go with one firm for our Series A. So it does change the dynamic, and we now rely much more heavily on Kleiner to support us for kind of all our initiatives, and often because they're called in for comment or for quotes. But there's no reason why it should sour your investment, and some of the funds I've mentioned have actually quite strict policies about not doing competitive deals if they've even just chipped into your seed rounds. And so it's a kind of a funny dynamic. It's a wonderful problem to have, and we're kind of figuring it out at the moment. But absolutely, now the biggest difference between seed and Series A, of course, is that the kind of, without swearing, the kind of show of a seed stage company is kind of brought into a more orderly fashion, where you suddenly have 6 board meetings every 6 weeks. You have to prepare a pack, or the kind of internal metrics you throw around with your team suddenly become scrutinized by a leading venture capital fund. But that's, again, a wonderful problem to have, because it lights a fire under your ass, and you're accountable, and you work even kind of 2% harder than you did as a seed stage company. So massive change. It feels very different. There are positives. Much easier to recruit when you have a Series A behind you that someone's read about in TechCrunch. Just the fact that you have Runway. We raised $1 million seed round, and then an extra $700,000 kind of a year after that. But we never really had more than months left. And when you're hiring very awesome kind of engineers or entrepreneurs to your team, you have to sit there with a straight face and say, we've only got 3.5 months left, but it's going to be fine. And that's tricky, and I've got better at doing it. But for the first time, I think that doesn't make me sound good. But the biggest change is being able to sit there at a table and know that you have potentially 2.5 to 3 years of runway, and it makes you much more zen. It makes you much more patient about product decisions, that you would wait the extra month to launch product, because it will be just the perfect product by the time it launches, instead of just hacking something together. So I think the biggest thing, obviously, that a Series A changes is structure and pressure from above, but the flip side of that is time, and that's a very valuable commodity. So, and again, to the point of time, we didn't raise enough seed capital. So if I could go back in time to your point, I think the seed rounds are now getting done at $2 million, whereas 5 years ago that was somewhat unheard of. Yeah, for anyone in the room about to do it, raise way more than you think. And everyone told me that. Everyone said, you'll listen to this, but you won't really listen. Please raise more than you think you need. But of course you don't. You think crap, I don't want to dilute myself, I don't want to dilute my founders. No way, like raise the money you can take at the time. I promise you it will take longer than you think to get to Series A.
So, just something to keep in mind when you think of seed and raising a seed round. Don't get caught up on the letter again. Realize that a seed now is what historically was a Series A round. And so when you're talking about raise as much as you can, yeah, if you're an extremely early stage company raising a seed round and you say to yourself, hey, this is my first round of financing, so it's seed, and you go out and try to raise $2 million from angels and even on Angel List, that's really difficult to do. You need to be at a point where you can actually sit down and have an institutional, call it micro VC, lead the round, and then others will follow and fill out the round. But to try to get together, if you haven't hit that inflection point to pique the interest of an institutional investor, then step away from what is defined as seed and go to angel, raise an angel round, and then get to that point, hit some milestones, and then get out and start having the conversations around a true seed round.
Yeah, the one sort of caveat, I totally agree, raise as much as you can at every stage. But the one thing I would say is always act like you'd have 2 months of runway. Because it's, we sort of see people, when you raise a particular amount, all of a sudden it's like, oh, we've got forever, and then you're going to have to raise again, and you're going to need to be at a particular plateau at that point. So yeah, just sort of keep that fire all the time.
I'm just going to pause really quickly in case any of this, because I know we've been kind of just going rapid fire here, inspired any questions or clarification that you guys want. Yeah?
So you talk a lot about the first round of funding or whatever, but what about, okay, so spend a lot of time, entrepreneurs spend a lot of time chasing investors or maybe getting the attention of investors. But once you actually get that meeting, I would love to hear from guys on the investment side, like, what are some of the things that really tend to resonate with you well, or what are some things when you meet with somebody for that first time, you're like, this, you guys just have a good feeling about the deal, or what are some opposite, the horror stories, what definitely should you do in that first meeting, and then from the founders who've raised, you probably had to pitch to multiple investors, so maybe you can say with some of your best meetings, what did you do in some of those meetings that you might have done different from your first meetings? Talk about that process, maybe.
Yeah, so that's tough. I mean, it depends what sector you're in. It depends what stage you're at on what gets us excited. So I'll try to keep it kind of high level. I think, the first is exhibit domain experience in whatever you're doing. Have a venture-backed business, so that means a massive market where you can capture a lot of that value. And then I'd say have a unique advantage and prove it, or at least show a roadmap to how you're going to capture value based on that unique advantage. So those are kind of a few high-level things. There's nothing specific there. So it's hard to generalize, but maybe a couple other things. A very tight-knit, complete team. And if it's not complete, just be upfront about that, and put forth the kind of gaps in your team and where you need to fill that and how you're going to have to fill that. So I'd say, just look at your business in total and say, here are the risks and here's how we think we're going to mitigate those risks. And don't come in saying, this is exactly how it's going to happen in this order, and then we're going to be $1 billion company. So be smart enough to have some flexibility in the model, and then really have thought through a lot of the questions that the investors are going to ask, and they're going to ask, a million things around competition, around market, around the product set, around the feature set, around the technology itself. And so just having, deep domain knowledge in and around those areas is helpful.
Yeah, so one thing that worked really well for us in a couple of meetings with VCs has been, and there's a lot of people have different opinions around this, but that was definitely not having a pitch deck. And I know some people say that's really bad, and but it actually worked extremely well for us. So the 2 meetings with VCs where we did not have a pitch deck, we raised money. Where we were just talking, and it was just a really good conversation, exchanging ideas. The VC in question had like a lot of knowledge in the space. That we had a great conversation, and everyone seemed to really like each other. And that dynamics totally sometimes goes away when it's just an entrepreneur trying to convince someone of their great idea. Yeah, so that's worked very well for us at least. And then the situation you were talking about, chasing VCs, I think that generally is a bad start. It's just really good to have that inbound interest. Like, of course, it always is. So when we started to have success with our investor meetings was just when the interest came from the VC.
Yeah, I agree. And kind of 2 things for me. One would be just an absolutely killer product demo. So we built the first kind of iPhone app for a landlord or broker on the supply side in our market to post rental inventory from their iPhone or ultimately Android device. So instead of a landlord like taking photos, plugging a USB cable, doing their stuff onto Craigslist from their desktop, we built the first ever iPhone app, and let's do that, all of that stuff from their iPhone and distribute it to our site, Zillow, Trulia, Hotpads, and then in real time pushes the listing live to our consumer app, where we have thousands of people every week who are sitting in a Starbucks in the West Village, and they get push notifications of apartments that just went onto market 200 meters away. And so we demoed these 2 apps to kind of all our VCs in these meetings, and that went from again, we actually had a PowerPoint deck, but it was irrelevant somewhat when the kind of the tipping point was like, holy shit, sure, of course this is a mobile to mobile world, and kind of real estate rentals, people shouldn't be doing stuff from their desktop, it's insane. So that was one tipping point, is just show in 3 minutes what your product does, no longer. Just there should be an obvious tipping point for people. And the second thing we had was have one line, have like a absolute 1 killer metric or 1 line that people will leave the partner meeting and go and talk about it over the coffee or bagels or whatever they're having afterwards. They're not going to remember 50 slides of your deck. They don't give a shit where people went to school. They will remember 1 line, 1 metric, 1 killer stat, whether it's the traction and the kind of growth curve that I was talking about 10 minutes ago, or it is a liquidity number if we just own this percentage of this market. For us, it was a growth curve, but it was kind of quantified into a growth rate. And that's what they go away with. You just got to think of that 1 line email they're going to send to their partnership to be we're going to do this for this reason. And I think it's easy when you write 45 slide PowerPoint text for that to get lost. But it's have 1 line that just really sticks, that when they come in and vouch for you in their partner meeting, they'll use that 1 line and just drill it home.
And this may sound silly, and maybe hopefully it's not too obvious, because we actually find that a lot of entrepreneurs, when they identify, say Chris is the ideal investor they want to get in front of, there's such an eagerness to get in front of them and pitch them, because you want to fundraise as quickly as possible, right? The top 10 list of investors they want to get, first thing they're trying to do is get in front of Chris. Don't start off with the most optimal investor when you've done your diligence and identified them. Don't start off there with your pitch. To the points you guys were made, you find out and get a lot of information in the first few or even more than few pitch sessions. And what you want to do is, by the time you're in front of that perfect VC you've identified, you want to have a pitch that's polished, you know how to articulate things very succinctly and get their interest on the spot. And so don't let your eagerness of getting in front of them keep you from kind of taking a very measured approach towards speaking to investors.
And also to Anne's point about having that 1 metric or 1 line, and it should support whatever that is. It should support your very clear and concise thesis about what you're tackling and what the problem is. Because too often, I know I've seen when working with founders on their pitch deck or talking to them about what they're working on, having something that's a little bit, trying to tackle too many things at once because you see a lot of opportunity out there. And really just focusing it down on what exactly it is that you're going to do very well that distinguishes you in that market. Speaking of which, I think this got brought up a lot, but every market is crowded right now. and there's just a lot of companies trying to do really similar things, so differentiating yourself is difficult. But are there certain sectors that you think investors are most excited about these days, or is there like a vertical that's too oversaturated? What types of problems are you guys most excited about people potentially solving, and which ones are they a little bit like less excitable right now?
I guess I can take a crack at this one. No, I think there's still, a lot of sectors we're interested in. Fintech is one, fintech, fin services broadly. We have a deep portfolio there. We continue to look at everything from payments to services to recreating banking infrastructure to Bitcoin. So fintech broadly gets us excited. We think there's still a lot of room for new companies to capture value there. I would say another one is what we're calling the smart enterprise. So it's about, that there was this revolution around big data and how do we capture it. Now it's about using that to make smart decisions within the enterprise and to do that automatically. So we've made a number of investments recently there. We're continuing to just kind of look at very vertical SaaS applications that can create a smart enterprise. I would say on that point, another one we've been looking at is kind of just customer acquisition, marketing automation broadly across both enterprise and consumer, just helping companies find and speak to those consumers, whether they're on the enterprise or consumer side. So those are a few sectors that we're excited about. And then getting into things that are maybe a few years out, but Internet of Things, connected devices, looking for protocols, robotics. These are things that we see kind of out on the frontier, but are paying close attention to. So those are a handful of things. In terms of what's being overfunded, that's difficult. I mean, probably the most popular pitch I heard in the last 12 months is crowdfunding. I think AngelList has mind share there, so going after that space is difficult, and it's kind of low barrier to entry. So I've probably seen or heard 50 pitches around crowdfunding, so probably stay away from that space. Or maybe not, and maybe play the contrarian view. I don't know. That one's difficult. So I don't know. Do you guys have interesting stats on what people are building? I don't know.
Yeah, I mean, I'd say I actually like hardware companies are some of the most, at least to me, most interesting lately. Like there's Double Robotics and Transcriptic and all the. It's kind of a new thing. To suddenly think of the internet as like a thing that can actually touch the real world. I mean, like you can almost think of Uber as a hardware company in some ways. There's all these kind of services that are so, and like, I mean, Outbox didn't quite stick it through, but sort of services like that. That to me is the most, those are the most interesting companies where they kind of go from like the, throw the middle finger to the cloud and move it into the real world. I think is kind of the most interesting stuff that I've seen. But particularly crowded spaces, I mean, any of the kind of like super low barrier to, I mean, like you said, crowdfunding is well, I mean, you can argue whether it's low barrier to entry once you get to sort of do it at scale and handle the legal requirements and that sort of thing. But that's one that you see a ton of people kind of rise and fall. All the little like coupon apps and rewards programs and stuff like that is kind of one of the most almost like sickeningly crowded spaces, I would say. And all those kind of things where it's just like, I mean, it's the same thing you could have said at any point in time. But the things that are super low barrier to entry, of course, tons of people are doing it.
I want to turn it over because we're running low on time. But I obviously have a ton more questions I could ask. But I wanted to give you guys the opportunity, if anybody else had some more specific questions that they wanted to ask anyone on the panel.
We've got enough of us.
Okay, great, because I have more questions. Okay, I think something